Hello and welcome to Building Confidence in Real Estate Investing. I'm Jenny Utz, and I'm going to be walking you through some key steps in what it looks like to invest in real estate and do it confidently. Today, I want to talk about the rental market for single-family homes and how it is set to just skyrocket right now. The first thing I want to talk about is how right now we're in such a demand that it's going to take about 2 million properties to hit the market for real estate rentals in order to meet the demand that we have. And what does that even look like? That's for the trajectory of the next 2 years. Single-family homes are starting to be considered the most lucrative investment in today's environment. And what that does is it's also allowing people to build spec homes for the sole purpose of renting them out. A lot of times, people are always talking about what it looks like to buy a single family versus renting, and why people might think that renting is so bad. But what is happening is with interest rates today, the cost of a rental is a lot less than with the interest rates happening. And so in order to meet the demand that people are putting on for rental properties, there are a lot of construction that's going to need to happen. There was a huge project that was just put out last year, over 100 some units that were put out. However, because of the interest rates and the additional costs that it is happening in order to get these properties built, there's also a ton of properties being put on hold because the funds are just not matching the expenses. The low inventory for buying is also what's keeping renters staying content. In our properties, we're seeing the national average is about 53% of renters staying in their property for an additional year after their year lease is up. What we're seeing in our properties is an over 72% of tenants renewing their lease. There could be several factors to that. One, they could be very content where they are. They like the property. We've done a good job. And I think that might have a lot to do with it. Number two, they can't find a property that they want to buy or move into. And I think that also plays a big factor. We've got a tenant right now who had to switch to a month lease after their year lease, thinking that they would be able to find a property that they can buy and move into. Unfortunately, they haven't been able to find a property yet because the market is just so tight. So they just continue to rent. So that low inventory, and what that is doing for the rental market is causing a 3%, a 4%, in some cases 5% rental increases year after year because it's trying to keep up with the demand. We saw an even higher rental increase through the COVID timeframe, but rental prices are also trying to keep up with the demand. Every time we put a property for rent back on the market, or we bring a new property in and put that on the market, they're gone so fast because so many people are looking for properties and the inventory is just not there. And that's how you know that building a real estate portfolio long-term specifically is a really good investment. For us, even in the COVID timeframe, we were still getting paid our rental amount, or we were having third parties pay on behalf of our tenants who couldn't pay. So no matter what, people are always going to need a place to live. So finding a property that suits you financially and is lucrative financially to give back to you is key to winning in the real estate market. And the reason single-family homes are such a coveted investment right now, we've got people looking for properties, but we also have an opportunity. So it's hard to find a property with the current interest rate to buy right now. So what does that look like for you, and how can you leverage that? Well, you could take the property that you're living in now, the single-family home or whatever property you own that you are living in full time. You could turn that into an investment property and buy another property to live in. The reason you might want to do that is because you've got a really low interest rate. So your mortgage payment is probably lower than someone else would be able to get if they bought an investment property. The rent that you potentially then could get is going to be higher. If you bought an investment property instead, you're going to have a higher interest rate, and you're also going to have to put a lot more money down. So being able to leverage your primary house is another good way to offset this demand. You're using an asset that you already have and can feed it into into the rental inventory, better giving you the chances of renting that out for a higher amount of money. We've seen build to rent communities being built, 45% increase from where it was before. That is such a big number, and that's one that we should not look away from. So another thing to consider is what it looks like. If you don't want to be a hands-on investor, finding a syndication deal where they're building these single family properties, and you can get a part of that by just putting some of your money into their funding. Then you would just get returns from them. So there's so many different ways that you can invest, whether you want to be a hands-on investor, whether you want to use your primary residence initially to buy or to get started into real estate. There's so many good ways to do it. There's no one size fits all for investors. And that's what I love about this real estate investing world. I started out being that person who used my primary residence. I then bought another primary residence and used my first primary as a rental property. I then became an investor down the road to start buying foreclosures and fixing them up and flipping them while also still owning long-term property. I then became an investor who bought short-term properties or international properties. Just because you're an investor in one sense today doesn't mean you're going to stay that way. And it means that you can build onto that. But there's so many things that you can do even inside the long-term route that is just no one size fits all. And so building a community and a professional network of what that looks like for you is very important, because just listening to what someone's saying, or even myself listening to me, my journey is not going to be the same as what your journey is. So how can you blend what your journey is, what your long-term goals are, and what you want your outcome to be, your why, and blend that together to figure out how to get started and how to be successful in real estate investing? And that's the key, is figuring out all of those pieces and putting them together. So working with the right people is crucial in order to do that. So in order to get started in real estate investing, some crucial things, especially for single family homes, what that looks like and how you can do it. 1, increase your credit score. Of course, most people know this, but it warrants being said again. Make sure that your credit is in a place that you are able to buy with your credit power. And if your credit might not be good, talk to me, talk to a real estate agent that you know, be referred to a mortgage lender, somebody who can help build your credit and repair things. They can walk you through what that looks like. They can guide you on credit cards that you should pay off, things you should consolidate together. There's so many steps that can be taken, and in some instances, pretty quickly affect your credit and in a positive way, and you'd be ready to buy then. Just remember, when you're working with your credit and getting credit approved, there's different criteria for a single family home that's going to be your primary versus an investment property, and what your debt to income is. So all of those things are important to look at and keep in mind. So the rental portfolio, buying your first rental, like I said, your debt to income ratio will allow you to be approved much faster. And so if you used your primary residence though as a first investment property, and then you bought another property as your primary residence, you then could get a loan or refinance on your primary if you wanted to, and use a DSCR loan, which is only going off of the income that you're getting for your rental property, while you're then just getting a regular loan, 3%, 5%, 10% down with a lower interest rate. And that would be part of the house hacking. Another part of house hacking that you could do is, if you've got a nice house that's got room or an addition, a basement, a room over a garage, you could turn those into a living area for someone to rent out. That means you're living in one section and renting out another section. That's a phenomenal way to get started. You would have been paying for your full mortgage payment, and someone is either paying all of it or a large portion of it, freeing up some extra cash for you to be able to save and use it as a down payment for something else. One thing I've also done is, number 4 would be live in your home and move every 2 years. When I first started out in real estate, I wasn't making a ton of money because I was new and I was young. And so I had to build up my real estate portfolio and my client base. And what that looked like is, I also knew what my long-term goals were. And so I was putting a lot of my income back into building my business, and I was okay with that. But what I knew also was that it would take me a little bit longer to start investing in properties if I was going to do it that way. So what I decided to do, because I had a little bit of the flexibility that I don't mind moving. So if you do mind moving and you don't like packing things up, and your home is your family home and that is the way it's going to be, then this isn't for you either. But living in your home and moving every 2 years, that's a great way to build up your portfolio. In 10 years, you're going to have 5 investment properties. When you have 5 investment properties, you have some cash flow coming in monthly. in addition to them paying your mortgage payment. But then think about what the market will look like as things appreciate. And then when the interest rate decreases a little bit, if you can refinance those properties, pull out cash, you'll then have all the equity in that cash at a lower interest rate. So you're probably not going to have a much difference in a mortgage payment at that point. And now you've got a lump sum of cash that you can go and reinvest in a larger property, a fix and flip property, several long-term buy and holds. So the sky's the limit when it comes to that. It's just figuring out, once again, what method it is that you want to get started with, how you want to get started, and what that path looks like for you. The buy, rehab, rent, and refi method, that's another great method. And so talking about what that looks like, you can get into a property like that without even using any of your own funds if you wanted. You can use a hard money lender and they might attach to your primary residence or a second home or something like that. But you could get into that property with little money down. They would then also pay for the amount of rehab work that would need to be done. And then you refinance the property out once you've put a tenant in place and pull that cash back out to pay the hard money lender. That's a great way to get started as well. You just need to know and understand what the time frame is for that. If it's a quick 3-month, 6-month, if it's a big project, and understanding your limitations. So probably chances are, if you're getting into this for the first time and you don't have someone who's seasoned or experienced working with you, that a hard money lender may not be interested in taking the risk on you if you're wanting to do a large project. For example, I'm about to do a project that it cost me about $200,000 to buy the property, but it's going to cost me about $600,000 for the rehab. It's a large house and the owner had just left it. It's a shell. There's no plumbing, there's no nothing. So everything has to be done, plus some of the things that he did do needs to be fixed, including getting the architectural, structural engineer, all of those things. So if you're talking about a very large project like that, that could have a lot of bumps along the way, you may not get funding for that, or it's going to be extremely high because of the risk that the hard money lender is going to take. So if you're starting out in the fix and flip or the BRRRR method, I would suggest finding properties that just basically need a coat of paint, some freshness, maybe a kitchen, flooring, just the cosmetic stuff. Because when you get into the things that are a little bit more in depth, it opens up the door and the can for there to be potential issues. And when it gets into that, there are times where a hard money lender is going to want to see a little bit of depth in your portfolio and experience to know that you know how to handle that and what that looks like. Another way that you can get involved in buying real estate is if you've got assets, a 401k or things like that, that you can take from that aren't giving you as much of a return as you could get in real estate right now. Take some of those funds. There's different methods that you could do so you don't get taxed on that, putting it into a different 401k or a different IRA and then being able to pull from that. So I can send you to a financial planner that does those things specifically real estate related. And you just pull from those funds and then you're able to buy a property. And then when you sell or refinance that property, you put the funds back in. So there's so many different methods that most people don't know about, but it's about asking the right questions, understanding what it looks like for you and how you can make it work. Another great way is borrowing money from friends or family. You could even make it that you bring them into the deal. They could be your financial backing. You could create an LLC and you guys be 50-50 partners. As long as you do the work, the back end, they are your money people. That's always an option too. I've been money people for several investors. I've asked for money from several people. It just is a matter of the timing and what it looks like and the type of deal that it is. You can take out a home equity line of credit on your current property to start buying investment properties. There's ways that you can do that. And so we could talk about that as well. But basically what I'm trying to show you is what it looks like to invest and how many different avenues you can do, all giving you the same outcome. With buying long-term, you could still do some of this to buy short-term properties. It's just a matter of connecting the dots. So many people don't want to remove expenses out of their life. But one of the things that I always like to do to tell people is you either want to earn more money or reduce some expenses. And the reason I say that is not to tell people that they need to change their lifestyle. By no means do I say that you can't have something nice. But one of the things that I always look at is what does it look like to replace an expense first with an asset. So I would rather take the money instead of buying that boat or a brand new car or something like that first, take the money that I would put down on that, buy an investment property, and then let the cash flow, those monthly payments that are coming into you in the form of rent that is over what your mortgage payment is, let that money stand in the way of what your boat payment's going to be. So if you're going to be netting $400 a month on that rental property, can you get a boat that costs monthly payment wise $400? Now you've got an asset covering your expense. So many people are doing this the opposite and they're never getting to that asset. So when you've got the expense paid off, so for in this example, we're talking about a boat. When you've got that expense paid off and now we're just looking at an asset, now the asset is making you all of that money, plus it's appreciated, and now you've got a boat that's been paid for by your tenants. How freeing of a feeling is that? Most people aren't investing because they've spent so much money getting the things that they want, because we're in such a now society. We're in a society right now that we can buy something with the click of one button. So who wants to wait to build up a savings account? Nobody wants to. So I just saw, I think it was today, somebody is considered being wealthy in the United States if they have $4,900 to their name. Think about that. $4,900 to the name is what is considered wealthy right now. I think I saw also it was like $94,000 to be considered in your name above what your payroll. Think about how much you would be able to have to your name when you're starting to talk about the assets that you've built in your portfolio that are sitting there. If you could sell them, you would wind up having $2 million, $3 million, $4 million to your name by having these assets instead of spending so much time trying to save a little bit of cash here and there. So one of the things that I also wanted to talk about is what it looks like in, I think, 2024 in the first quarter, the single family rental market report that was put out, and they listed the top 10 areas that are great for rentals right now. And so I want to go over them and look at what it is from year over year wage growth and annual gross rental yield. So number one, rounding out number one is Indian River, Florida. They've got a 1.4% year over year wage growth and a 14.6% annual gross rental yield in 2024. Number two, St. Louis. You have a 2.6 year over year wage growth and a 14.6 annual gross rental yield in 2024. Number three, Cameron, Texas, and a 13.2% annual gross rental yield. Monroe, New York was number four at a 2.6 year over year wage growth and a 12.8% annual gross rental yield. Richmond, Georgia, 0.1% year over year growth and a 12.7% annual gross rental yield. Hidalgo, Texas was 3.7% year over year wage growth at a 12.7% annual gross rental yield. And make sure if you have any interest in buying property outside of the area you're living in, you're making notes of this, because for me, these would be some of the areas that I would go and start checking out and seeing if these are areas that I want to buy in because of the growth potential. The next is Collier, Florida, 1.6% year over year wage growth, 12.4% annual gross rental yield. Number 8, Montgomery, Alabama, 3.3% year over year wage growth, 12.2% annual gross rental yield. Jefferson, Alabama, 2.5% year over year wage growth at a 12.1% annual gross rental yield. And number 10, Wayne, Michigan, 2.6% year over year wage growth and 12% annual gross rental yield. And these are so important to know because what this is doing is it is showing you the potential in these areas to buy and be successful. Now, that's not to say that you can't be successful in your own backyard, because you can. You just need to find the right properties. But if you were going to go somewhere outside of your area, I would highly recommend starting to talk to some of the people in this area. For example, I'm down here right now in the Tampa St. Pete area. This is another area that I'm looking to invest. So if you're going to invest outside of what you know, which would be your current backyard, your town, your area, it's not enough to just hire a realtor and have them start sending you properties. I said this last week, but I'll say it again. I also am from Maryland. And if you know anything about Baltimore City or have heard anything about Baltimore City in the news, you know know, Baltimore City can be very different street by street. And if you were going to just tell a real estate agent, I want to invest, and this is the 5-mile radius to look for, that 5-mile radius could look very different. And I think that is very important. So I'm down here. I've been down here in the Tampa area for a couple weeks. It's very important for you to do your due diligence and what that looks like for you. I've talked to several investors down here. I've talked to several real estate agents. I've now driven around areas that I'm pretty sure are areas that I want to invest in. I did the same thing when I bought internationally. I was over in that area many times, many locals, talked to several realtors, and I started understanding the area that we were in before I even thought about buying, to make sure it was an area that I was interested in. So there is homework that needs to be done on your part before you just say, give me the best property in this area for a real estate investment. It doesn't always work that way. Like I said, street to street in Baltimore City is very different. You don't want to invest in an area that you're going to be the very first one to build that up and coming area. Tenants are not going to like that, and you're not going to get the type of return that you would in any other situation. Airbnb, on the other hand, I always like to go in the more up and coming areas, just on the outskirts of the good parts and right on the brink. So you don't want it to be unsafe for your guests, but those up and coming areas for Airbnb though are really good, because you can get to that, you can get downtown or get to wherever they're looking to go, but you're getting at a really good deal, and you know within the next 5 to 10 years that those areas are going to be built out. So two very different methods, depending if you're going long-term or short-term, in how you handle investigating and ultimately finding your investment property.